We have with us today Mr. Gary Dugan and Rajat Suri for the fireside. A lot of you would have heard and met Gary in the past, but for those who haven't, Gary comes with a rich experience of over 40 years of global investing. He's currently the CEO of the Global CIO Office, which is an outsourced CIO function for several regional wealth management firms. In the past, Gary has been an equity market strategist and also CIO at leading wealth management firms, including Namara Wealth, Emirates NBD, Coutts, Merrill Lynch, Barclays Wealth, and JP Morgan Investment Management. We've known Gary as somebody who doesn't shy away from making bold calls. And if you look at his long career, he's called the crash of 1987, the Eurozone rise, the tech bubble of 2000, GFC of 2008. And in fact, recently during COVID also, he had, we've had many conversations with him, and his suggestion to investors was to raise cash. So we've seen all of that. And his calls working out. In fact, he recently went underweight US as well. So, we are looking forward to talking to you, Gary, and thank you for joining us. We also have, along with Gary, Rajat Suri. Rajat is an institutional portfolio manager at ARGA Investment Management, and he's responsible for managing investments for institutional clients. ARGA is a global value manager. They manage $13 billion, which is closer to 110,000 crores in Indian rupee terms. And they do this across 114 institutional clients. ARGA has also been a sub-advisor to Vanguard's value strategy. Before joining ARGA, Rajat was running his own firm. And prior to that, he was the head of public equities at Qatar Investment Authority, one of the world's largest sovereign funds. So Rajat has not only, been a part of ARGA and seen ARGA from the inside, he's also seen ARGA as an investor and experienced ARGA as an investor. Before joining, earlier in his career, Rajat was a research analyst at Credit Suisse and Cornerstone Research. He's MBA from Harvard, and he's done his BA honors from University of Pennsylvania. Thank you so much, Rajat and Gary, for joining in today. We're just going to take Sahil, you may want to stop sharing the screen. Thank you.
Just a moment.
Yeah, so Rajat, Gary, once again, welcome. We're going to dive straight into the fireside chat. Gary, I'll start with you. Global investing has been gaining popularity in India over the past few years. It's always been a view that international diversification is important, but it is equally important to look beyond US and US tech. So now here we are, a big rate hike cycle later. Gary, how are you finding this environment to invest, and how are you building portfolios right now?
Yeah, well, firstly, thank you for giving me the opportunity and sharing my views, and great to see you, Roopali. Yeah, I mean, it's interesting. You're looking at markets which have given double-digit returns in many parts of the world since the beginning of the year, and yet we've had all of these increases in interest rates and a lot of negativity on the street. And I think it's just that people have kind of got used to the idea that inflation actually creates corporate profits as much as interest rates create headwinds. And I still believe that a well-diversified portfolio shouldn't be the 65% that it keeps trying to force us to do in the United States, but that there are opportunities elsewhere. Now, clearly for global investors, India's probably up there at the moment as probably number one for most investors. But even beyond India, we do believe that places like Japan are going through a massive structural change, and I can't speak highly enough of what we've seen since the beginning of the year, after the stock exchange authorities put pressure on corporates to deliver value back to shareholders. Secondly, in the way in which we think about investment is try and get away from this kind of idea that we should keep concentrating on countries. I do believe there are a lot of thematic great ideas out there, and there are better ways to invest in rather than just choosing countries, which means that you get that diversification away from the US. I'll give you one, again, good example would be the luxury goods sector, which has been a tremendous performer this year. I still, it's kind of unbelievable it's done so well when China has not been contributing so well to global growth and is still to come in. So if you're investing in parts of the world that don't seem to have a good macro story in the background, there's often sectors within the mix that give you a significant weighting in your portfolios, because I've got a great deal of conviction that people will still be buying expensive, overpriced luxury goods, because that's where the growth of the world is, in the emerging world, and the emerging world is aspirational for many of the brands. So when we're looking around the world, it's those kind of things that we think ex the US that give us an investment opportunity. The last point I'd make is, yes, I've had a bit of a downer on the technology sector. I've not always got that call right. I have to say that I'm reformed. And I would draw an analogy, because I always get people laughing at me saying I've still got my email address with AOL at the end of it. So I am .aol.com. And if you go back to when I took that subscription on in 1990, there was exponential growth in the internet sector. And I think, the new kid on the block is AI. And quite frankly, the impact on the technology sector has been a matter of months, at least in terms of stock market size. So I do believe there, again, great growth opportunities, but of course, very focused. So it's not just about the US economy. That's the point I want to make. It's not just about the US economy. It's about opportunities outside of that, and particularly in some of these sector thematics.
For the longest, we've been watching the US and the US markets and, wondering when the shoe drops. But, after that, after a sharp correction, it's back to, being on fire. But, earlier on, when the rate hike cycle looked like it is going to be imminent at some point in time, we were looking for alternatives, and that is when we started speaking to ARGA. And as a value manager, we wanted to evaluate what does the landscape for value look like. Rajat, I want to ask you this. Value is back in favor. Came back in favor after a very long time. Specifically in emerging markets, are you seeing opportunities bubble up? I'm also asking this question because the general perception is that emerging markets is about growth, and there is skepticism around whether value can really outperform. So, please share us your thoughts.
Yeah, no, absolutely. And it's not that we're opposed to growth. I mean, who doesn't want their companies to be growing? It's just that we know there's a fair price to pay for everything, and our responsibility to our clients, that you mentioned up front, is to find companies where their valuation today at which we enter allows us a lot of upside, and then gives us a lot of downside protection, because it's not that they're become so expensive. So as eh, I know the last 10 years has been a very special period, Rupali. I mean, if you go back, and do historical studies going back 50, 80, 100 years, right? We do think that buying cheaply is one of the big drivers of being able to outperform. Now, having said that, when interest rates were zero, and it didn't matter when your cash flows were coming, as in, were the cash flows coming today, or are they going to come 30 years down the line? Obviously, growth as a theme did particularly well. And, I think the United States was probably the biggest beneficiary of that. Interest rates aren't zero anymore. And it's unlikely, in our view, that they'll go back to zero anytime soon. And so what we've seen, more in emerging markets, less so in the United States, is that value has started to outperform again after a 10, 12-year period. But reality is, over long histories, value does tend to do well. As we look across the world, we're not just an emerging market manager. We have a global platform. We have a U.S. fund. We have European strategy, Asia, emerging markets. We do think that emerging markets is the one. It's not a geography, but one sort of subset of the market where the value opportunities most pronounced. It's not to say that we're not finding opportunities in the US as well, but in emerging markets where China is obviously a big part of the universe, we are seeing probably the most attractive opportunities that we've seen since we've been doing this for 15 years.
Interesting you say that, because we've been talking about the ARGA fund, and China has quote unquote a special place in our minds, or let me say different place in our minds. And so in an environment where China has not been firing from all cylinders, and to top it up with all the geopolitical uncertainty, how do you incorporate all of that into your decision making, Rajat, when you decide to, you have like a 30% exposure to in your EM fund to China? So how do you incorporate all of that?
Yeah, no, absolutely. Look, reality is when you're a value manager, you have to be realistic, right? That you can't invest in something that's firing on all cylinders, because, if it is, like India is today, maybe for many, you're probably not going to be getting it at the price that you want. Look, when we look at China, by the way, we've been running our emerging market strategy for 13 years. This in the last year is only the second time that we've been overweight China, and it's not that we have a differentiated macro view. Gary might, but we're bottoms up stock pickers, and we respond to where we see the best value opportunities. And I think in the case of China, the risks are all pretty well understood. I mean, this market is down 50% plus from 2 years ago, right? And I think the risks are also in the stock prices for the most part. For example, we know China is not going to grow at 8 to 10% anymore. No country can do that for decades and decades at the size that they are. We know growth is going to slow. We know there's a property bubble. In fact, we count on the slump in property prices to go on for another few years. There was just overbuilding. We all understand that. We know the demographics are not in their favor, but I think these risks are already in most of the prices, right? And let's not forget, there's a lot of good things about China too. Look, it's a very innovative economy. I mean, obviously we know about the tech platforms there, but if you think about it, EV and battery technology, China is really at the forefront. On many other fronts, right? Macro stability in China is much better than most other emerging markets, right? In terms of debt ratios and things like that. So there's a lot of positive things going on when we look at it across the world, right? And look for bottoms up stock opportunities. We are seeing a lot of opportunities in China, especially in the consumer space. I mean, everything's been sold off, dramatically over the last 2 years for the risks that I mentioned. But reality is, there's still a lot of penetration stories still left in China. I mean, I look at a company called Gree, which is the largest AC maker in China. It doesn't really matter what GDP growth is. People, as country gets richer, they want more ACs. There's one AC per household in China. There's three in Japan, and China is a middle-income country now. So we know that penetration will continue. But there's a stock trading at 7 times earnings. The same company in India, which might say is Havells, is 55 times earnings. So there's a price for everything, and I think in China, everything's on sale, and that's why we have so much exposure there.
Gary, you have a broader mandate, right? So Rajat is talking to us in context of the EM fund. You have a broader mandate, and outside of Japan, you've also been liking ASEAN a lot. What's your perspective there?
Yeah, to be honest, picking up on the things that Rajat's been talking about, Asia is still delivering substantially more growth than the West. I say he's quibbling about the numbers of, with the Chinese government's not achieving 5%. Well, I'd be quite happy with 3.5% from any economy, given the world that we've been living in recent years. And I think that it goes back to valuation. It's not just China that's cheap. I mean, if you look across the broad complex, even a mature market like Singapore, valuation gap against the United States, I think is one of the biggest we've seen in some time, and yet many of those stocks also give good yield support. And I think the other thing is the emergence of markets that have been in the backwater before, and I will particularly pick out Indonesia, which have been fits and starts, but the moving capital, a lot of money's been spent, and I've never seen it when I was obviously I left Singapore about a year ago, but I was looking out across the waters, and you could just see this growth going on in Indonesia, which had been underappreciated outside of the region. If you sit inside the region, we were seeing so many private equity deals, so many good stories. Women who were in the workforce that hadn't been in the workforce before. I've talked to one of the biggest banks in Indonesia, and they were talking about the development of their financial product, and I couldn't believe how bad it was. But then I just saw this huge opportunity that you go from bad to medium good, and you get tremendous growth. So I still think that those dynamics are a huge contrast with the challenges the United States has got. I mean, also, this is a region that is under leveraged relative to the leverage that you see in the rest of the world, and where their currencies have not gone through the same kind of painful challenges of significant inflows and outflows of capital, which was a positive that came out of COVID. So I think it all still stacks up. I just wish China was growing faster, because that would certainly help the ASEAN region and make it a more emphatic outperformer. But I still think it's a good story for the next 1 to 2 years.
Well, we have mixed feelings about whether how fast we want China to grow. But that's almost not the investor, but the nationalist in me talking. But moving on, we've talked about China, we've talked about ASEAN. Rajat, typically the moment we say EM, and a lot of us here on the call today relate it to various parts of Asia, but there is this large non-Asia EM that is worth considering. So, can you give us a little bit color on the non-EM part of non-Asia part of EM?
Yeah, absolutely. Look, I mean, MSCI loosely, emerging markets, they put a lot in there. Very rich countries like Qatar and UAE, very poor countries, big countries, small countries. So, there's a lot of variety in that EM bucket. There's 24 countries, if I'm not mistaken. About half of them are outside of Asia. Latin America is a big part of that. The Middle East, GCC is a big part of that. Of those, Eastern Europe, of the areas where we, as value managers, I want to be very clear, we have a very clear style bias, where we see the most compelling opportunities. A little bit in ASEAN, as I think in agreement with Gary, but outside of Asia, Brazil is really a standout where we have quite a lot of exposure. I mean, it was a market that, like China, became sold off because of fears around the politics. I mean, with the leftist government being elected there late last year, reality is, a lot of that bad news was already in the price. I mean, we have, for example, there a company called Petrobras, a national oil company, is the second largest oil producer in the world. It got sold off because everybody's worried what the government will do with it. But reality is, this is probably the best positioned oil producing company anywhere in the world outside of Aramco. For 15 years, they've been developing technology to drill offshore, deep offshore. And as a result, they have one of the lowest costs of producing a barrel of oil. And they throw off a lot of cash flow. Last year, believe it or not, Roopali, this stock paid us almost a 50% dividend. I mean, that's incredible. That's the kind of value. We also see a lot of value in the banks in Brazil. And beyond Brazil, I might just call out Eastern Europe, countries like Poland, Hungary, Czech Republic. All of these markets became a little bit stressed around the war in Ukraine. Obviously, we're very close to the front line. But reality is, I think they're all on the path of being integrated into the EU. The macro is not terrible, and the stock prices became a bit oversold. So those are two non-Asian markets I would call out as opportunities for us.
Sure. Just just a question in my mind. Considering you are a US based firm, do you now, in this current context, look at Russia? And the reason I'm asking is about my earlier comment on geopolitical uncertainty, etc. So, can you and would you invest in Russia?
No,
Okay.
no, the sanctions won't allow us to invest in Russia anymore. So we never before the war started, we had significantly reduced our Russia exposure almost to zero, and at the moment we're not involved, and nor do we foresee being involved in there under the current setup.
Sure. Yeah, of course. So, we talk about Russia, we talk about Brazil, commodities pop up in my mind, and Gary has had some exposure to global infrastructure. Gary, we see a lot of it build out around us. The only other part where we see a lot of it being talked about is the renewal in the US of infrastructure. But outside of this, uh, is there a broader global infrastructure theme, or it is largely, US centric? What's going on?
Yeah, I think it appears US centric just because the US is a big country. And also, obviously, it's responding quickly to some of the green issues, particularly with the bill that went through the Inflation Reduction Act, which actually was just green, green everywhere. But I think, people forget how much has gone on in Europe. In fact, I was in the south coast of the UK. You could call it a blight, or you could say that it's green, but, the kind of offshore windmills were all flying, and there would seem to be hundreds of them. And the UK now gets a very significant part of its energy needs from that renewable source. So no, the infrastructure theme, I still think, is multi-year. It isn't just about building the roads and electrification that you see in India. It is a lot of this green energy thing. And there's two things to keep in mind. One is the energy transition requires not just an energy transition, but actually requires a lot of money going into the oil sector. Otherwise, we're going to have a seriously higher oil price in incoming years. And secondly, we're going to need to think about a broad improvement in the way in which we transmit any energy that's created. So whether it's EV charging or energy storage, that is, every street corner virtually needs energy storage. It's no good just having a solar farm that can't keep the energy overnight in sufficient quantity. So that scale of investment is massive. And I think, even though we seem to have been talking about this theme for some years, quite frankly, even in 2022, which is a difficult year, we saw a net $152 billion raised by infrastructure funds. So it just shows you that there's a huge amount of money to be deployed. I've been working with some of these industrialists. I can tell you there's still a shortage of capital for great ideas in this sector. We've got COP coming to the UAE at the end of this year, where I know there's a mountain of new initiatives coming, which will need funding. So I think this will continue to be a good sector to be in. You've got to be discerning about the technologies, but it's going at a pace. And I think it'll be almost a core sector, a core theme to markets as we go through the next 5 years.
And Rupali, if I may add, I think for the last 30 years, China was the suck of commodities, right? Because they were building, and we can say that they've probably overbuilt at the moment. But I think Gary's absolutely right. I mean, the kind of infrastructure renewal. Infrastructure development, particularly driven by renewables and a transition to green in Europe, in the United States, but also in other countries, even by the way, Brazil, is going to lead for a much more balanced demand for these kinds of commodities. So less reliant on China, which is obviously slowing down on the investment side, but other parts of the world are most certainly picking up. No short in part because of the subsidies that we're seeing in the United States, but also in Europe.
Yeah. So ever so often we see a lot of changes at a macro level. And then when it comes to translating that into stock picking opportunities, sometimes the sectors are not well represented, or, governance is an issue. And, you have all those kinds of challenges. So Rajat, from a portfolio construct point of view, can you tell us a little bit about, from ARGA's perspective, how do you, incorporate all of these factors into your investment decision making?
Yeah, absolutely. And again, the early part of this conversation has been more sort of country level and macro, but we're stock pickers. I think the good news for us is that we can be very, very selective. There are several thousand stocks listed in the emerging markets that we talked about. A lot of them in China, for sure. But at the end of the day, we are building reasonably concentrated portfolios of 50 to 70 stocks. So I will tell you that finding 50 or 70 ideas out of a universe of 2,000, not that it's easy, but there is plenty to choose from. I mean, we don't take a lot of Rupali macro top-down views. We don't think that's our skill set. What we do is focus on for whatever universe we're investing in this case, emerging markets, what is the cheapest subset of stocks out there on the traditional metrics like PE, price to book, etc. And then, as I mentioned, usually there's some sort of stress. And what our job is, we have a team of 50 research analysts, is to try and understand what is the source of stress. Is it temporary or permanent? If it's permanent, it's not really a candidate for us to invest. If the source of stress is temporary, a business cycle or a little bit more competition or something like that, but we think it'll dissipate over time, then that becomes an interesting investment idea for us. And again, we can be selective, and we're only looking for about 50, 60 stocks.
Yeah, makes sense. Gary, you incorporate a lot of top-down views, macro views into your thinking when you design portfolios. You've also been, you've also been underweight the US, and we've talked about it a little bit. I just wanted to, delve a little bit for another few minutes onto the US bit, because a lot of investors, in the last few years who have invested internationally, and talking about US investors from India, we find a lot of concentration in the US tech and those kind of opportunities. You've said that you're structurally, sort of muted on the US. Tell us a little bit more about that, and what needs to happen for you. Under what circumstances will you actually be compelled to change your view?
Yeah, let me just take this from a slightly quantitative approach. If you put an optimized portfolio together at the moment with the expected returns, which even I could take JP Morgan's or I could take any other quant house and put them into a simple optimizer, it tells me not to be at the full weight that the MSCI is trying to drive me to. MSCI would like me to be 65%, approximately, I'm rounding numbers, in the US equity market. So, when we have a conversation with a client, we talked about a diversification of investments. Then I start with 65% in one market. It doesn't seem well diversified. Now, yeah, there's many an argument around that thought. But so we've capped it at 50%, and that 50% has some quantitative backing, because what we've done is we've said that we'll take the Nasdaq out of the US market and we'll optimize that separately. So we end up with a portfolio that has a core position in the S&P 500 and it has another position in the Nasdaq index, and in aggregate that's only 50%. Now, in terms of where do I find those good returns that are going to make up for my underweighting of a market that has been profoundly strong over the last decade, I have my Nasdaq exposure, but I'm finding sectors, as I mentioned earlier, around the world that are going to give me an opportunity set that's going to match that US exposure. The second point I'd make is that the way in which we build multi-asset portfolios also makes up for some of that underweighting of the US, because we use asset classes such as private debt, where private debt markets can give you something between 7 and 12%, which quite frankly is a lot more return than the US market is expected to have over the next decade, and for a lot less volatility. So, as I said, that return that you might be giving up, and I'm skeptical whether the US actually will achieve 7% unless we have a lot of inflation. But it can be achieved through other sectors within the market and/or other asset classes giving you consistent returns with low volatility.
Rupali, I'm just sharing my screen. I think just to your question, I think this might be just as a picture says it has 1,000 words in it. I think to Gary's point, right? This is the CAPE. It's called the cyclically adjusted PE ratio. So it's the price that you're paying for that market, thinking about earnings not just this year but over a 10-year period. And as you can see, the dark blue line is the U.S. Now, I don't think anybody's disagreeing that the U.S. is a very dynamic economy with, obviously, a lot of innovation, lots of great tech companies. But as I started off the conversation, there's a price to pay for everything. And in the case of the United States, you're paying a lot. You're paying almost 25, 30 times cyclically adjusted P ratio. The last time it was there was the dot-com bubble. Now, put that into context. Look at the emerging market line, which is that the light blue line, and you've never seen a gap being bigger. And again, we don't come at the world thinking about, well, which is the best market to be in, or which is the cheapest market to be in. But what we're doing is looking for stocks, and we are finding that we find more opportunity as a value investor in these other countries that we've mentioned, that Gary and I have talked about, than the United States. And the simple reason being, the US, a little bit like India, is very expensive, not just relative to everybody else, but relative to its own history. And if you go back 25 years, it was the best time not to be in the US and to be in some of these other markets that we've talked about. But we never know if history repeats itself exactly, but there is a strong correlation between what you pay, i.e., the cape that you pay, and what you can expect in the future in terms of returns.
Absolutely, and which is why our whole quest of figuring out good managers in the non-US space, and which is why I chose choice of the EM fund. But you in your statement earlier, you also mentioned India. So no international investing conversation with Indian attendees can be complete without me asking, what do you think about India? So here it goes. What do you think about India?
Yeah, by the way, I'm not only asked about India by Indian clients, but even in the US, almost every meeting will have a question about India. Look, India's in the limelight, right? And obviously, I'm of Indian origin. Just for people's benefit, we almost half of our investment team sits in Chennai. So it's not like it's a market that we don't understand or know. And of course, everybody has home country bias. So I'm sure all your audience has quite a lot of exposure already in India. It's almost inevitable. But for us, again, we are looking for very, very cheap stocks which have a lot of upside to them. And then limited downside risk, again, because of the valuation which we're entering. And reality is that India is very much in the hot spot. Everybody wants a little piece of India, and for that reason, it is a particularly expensive market. We've had more exposure to India in the past, in 18, when there was a little bit of a financial crisis. But at the moment, we don't find a lot of opportunity in India. And maybe it's great. Maybe that's great that we never get the opportunity. That means India is doing very, very well.
True that. Gary, you've been a India watcher for a long time. You have family back here. You've been visiting. How are you seeing the India opportunity from the outside right now?
Yeah, if we don't talk about price, but we just talk about the mood, the change. I mean, I've been watching it for 20 years and visiting regularly, but I've never seen such momentum. I was in Jaipur recently, and I was just gobsmacked to find a Starbucks, and they told me that it had been open for 2 years, so I missed something there. So look, there is. I think it's just the international community is just becoming more aware. Just because it's taken time, but everyone now believes me that you can safely drive on a road, or that you can get to different parts of the world. I mean, I went around many places in India in the last few months, and I never stopped getting a good signal. I was in the UK for 10 days, and I stopped getting a signal on my mobile phone down in one of the coastal towns. I mean, there's huge contrast now in terms of the way in which India's grown up. But to the point that Rajat made about valuation, I think there just comes a point sometimes in the market cycle that valuation doesn't matter for a period of time, and I think that's going to be the case here, because we're seeing major investment houses or major private banks that just say, I'm putting up my weighting in India. Partly that's because that's what the clients want, and also they have a conviction, and they're insensitive to price. So I think I'm running into an election year next year where we know that GDP growth doesn't typically disappoint. I think people will just go with that momentum. And to be fair, when you look around the world, there are not too many convincing stories of this scale. I mean, I'm talking a story. Clearly, it's still a small country relative to some of the major markets, but it's something that is in short supply. because India is not just talking a story, it's delivering a story. And I think that's not the case in many parts of the world at the moment.
Yes, and we are actually it's just not the mood. We are actually experiencing this in many ways than one, including the entire, what we talked about earlier, the infrastructure build out and the knock-on effects. And, we're all the reforms, we're past that point, and now it looks like they're cohesively firing in favor of growth. But we're also in a larger global uncertainty or rather we are on the brink of a global slowdown or almost in one. So obviously it will have some amount of effect, but it continues to be a little bit of an oasis. So we continue to be constructive. We're I think, we've talked about pockets that we like. We talked about the pockets that we don't like and we find expensive. But at a broader level, I want to ask, both of you, where is the risk that you are seeing? So what should be investors wary of, when they are investing internationally at this point in time?
I'll defer to Gary first.
Sure.
I think you've got to be wary of human beings. And the human beings run governments, and human beings run central banks, and they're emotional, they're power hungry, and they do tend to make mistakes, and that's what gives us economic cycles. And I do think, unfortunately, we still remain in an economic environment where mistakes can be made. We've already seen that, and I screamed very loudly when the Fed wasn't increasing interest rates, and now we have to have rates probably far higher than was needed had they moved about 6 months earlier. And we still have governments who think they can, get out of their squeeze on their economy by spending ever more money, when debt to GDP ratios in developing world are, don't talk about downgrading from AAA to AA, but let's keep going, because some of these countries could be bust if confidence is lost. So I think that the worry would be policy mistakes. I still believe that inflation is going to be a more prolonged problem than we've perhaps accepted. We still won't accept that the Fed will probably not cut rates before the back end of next year, and everyone's hoping January they're going to save the day. So, as I said, I think it's policy mistakes, and I think you have to factor in there could be a policy mistake. I just want one last point I'd make about India. I think policy mistakes at the international level in the past that caused waves of capital to leave India. I think at least on this occasion, I think it's well protected. But I think some of the other emerging countries and countries that people are not convinced of could see significant capital out as people hunker down and go for safety. So, and I think we've still got to go through that phase sometime in the next 12 months.
Completely. And in fact, the interesting part of this time around has been that, markets have disbelieved Powell for the whole of last year, and they continue to disbelieve him while he's managed to get his agenda through. So that's the interesting part. It remains to be seen what ECB does, and there are a lot of us who think they're behind the curve. But in all of this, the interesting part of it was, Xi Jinping, through their Communist Party journal, actually a couple of days ago said that they're not going to emulate the West, and they're not going to, provide stimulus like the West has. So that's the interesting bit. But Rajat, over to you. This would be the last question for the evening, but please tell us, how are you seeing, what are the risks that you are seeing?
Yeah, I mean, maybe to piggyback on what Gary was saying, but he was talking more about from a policy perspective. But reality is, I think we've all been, most people have been surprised by the resilience of the U.S. consumer and corporate profitability. In the face of the inflation, persistent inflation, in the face of much higher cost of capital. Again, after a decade of near zero interest rates, we all got used to it. So I think there's still a part of me that fears that the shoe is still to drop. And for that reason, I think we are underweight the United States because of valuation, but there is a risk there that the corporate profitability cycle will turn down there. Now, for our emerging market fund, you say, oh well, okay, that's great not to be in the U.S., but reality is we know how investor psychology works, and if the U.S. is to face a profit crunch and a sharp derating as a result, and the markets sell off, it's hard to imagine that emerging markets, by and large, will be immune to it. So I think we all have to be prepared for some volatility along the way.
I agree, and in fact, in response to a lot of this, as I'm an asset allocator, so in response to a lot of this, we've been holding, gold overweight. I know that Gary also prefers to hold some gold in his portfolio, but that has been this year incredibly frustrating. But markets reward the folks who are patient.
Patience.
Yes, market rewards patience. So we are being incredibly patient. We feel the frustration, but we don't feel inclined to react to that and do anything at this point in time. We are, while India is the current darling of a lot of market participants, there's lots of interest. It's reflecting in the flows. But at an overarching level, we're also seeing all the stuff that is happening around us, and with US leading the bandwagon. So here we are. We want to run well-diversified portfolios. International investing is a very crucial component of that. But given where we are as a global economy, we're also, steadfastly holding gold. So on that note, I wanted to, say thank you to Gary and Rajat for, making time for joining us. For all our attendees, we have an opportunity to invest in ARGA through the Birla Emerging Market Gift AIF. It's currently open, and the benefit, of basically the reason why we are so keen on this is, outside of this, it's an institutional, they only have institutional investors. So this is the first time we're getting an opportunity to participate in a otherwise institutional manager. Gary is, helps us run the VCC that we have out of Singapore on the Crystal platform. So, where we have a broader mandate, and, we run, that nature is a little more evergreen. So if you have, we are happy to sort of respond to any queries that you might have around accessing either of these products, more conversations, and overall international investing as an experience. We would like to thank every one of you to join in and give us your time. We are happy. If you need anything beyond what we've just discussed today, please feel free to reach out to your wealth manager or us directly. Thank you so much. Thanks everybody for joining in. Thank you, Gary. Thank you, Sahil, once again.
Thank you. Thanks very much. Thank you.
Have a great evening.